We should talk about the Fed funds futures rates. Those are the pits where the guys bet on whether we will see an interest rate hike this year. Well, there's a 19% chance of a rate hike in June. We didn't get one today. December, that number then jumps to 70%. So I want to know from somebody who probably has a real sense of what's going to happen. Bond King Bill Gross, he's got $1.6 billion under management at Janus Capital. Bill, which month will we see a rate hike, if not this most recent meeting?
Oh, I think in June, Liz. Really? The Fed didn't mention it today, and that's one of the reasons why bonds are moving up in price and lower in yield, and perhaps why the stock market's up, 0.5% or so. But I think they will in June if global market conditions, continue to stabilize, and that's the key. I mean, the Fed is the global central banker, and they are dependent on relatively stable markets. And so over the last month or two, we've seen that. And if we continue to see it, I think in June.
You've made no bones about the fact that you really feel we need to have much more normalized rates, meaning higher rates. Why? Why do we need higher rates when we saw that a rate increase in December? Listen, I got so many tweets on this. We can't do it right now. It'll hurt the stock market. Why do you feel we need to do this now? Because markets aren't free, Liz. I mean, are there free markets anywhere? No, I would say, none that I can think of. Prices are artificially high everywhere. Yields are artificially low. Central banks have imposed negative interest rates in 50% of Euroland markets, and they're about to buy corporate bonds. The Bank of Japan is buying everything, even stocks. And so, is that a good thing? No. At some point, central banks have to begin to normalize interest rates, and yes, will that hurt the stock market temporarily? I suppose, but it's the economy that is the fail-safe for the Fed and other central banks, and the economy is not doing well with low to negative interest rates. And we need to stop punishing the savers. I'm sure you would agree with that. So where is the best bet for putting your money? Of course, you're in the unconstrained Janus Global Bond Fund. Unconstrained is a great word because you can basically go anywhere. Where do you see the most yield, I guess, for second half of 2016?
Well, I think that's a good bet. Janus Unconstrained, now that you gave me the lead in, it's a good bet for a 4 to 5% type of return with relatively low volatility. But, in this market in which interest rates are almost zero and in some cases negative, it really pays to borrow as opposed to lend. And so how does an average investor do that? Well, you can buy a company such as Janus Capital, and that's a mortgage REIT. They invest in agency mortgages, relatively riskless. Right. They're 6 times levered, which is not riskless, but they're sort of like a bank without the bank's infrastructure, and it yields 11.5%. The symbol's NOI. So borrow money or invest in a company that borrows instead of investing at low interest rates.
Bill, we've got about 15 seconds left, but we're hearing through the grapevine that PIMCO, your old stomping grounds, is looking for a new CEO. Does that surprise you? Your personal fund right now is outpacing your counterpart at PIMCO, where you left under not the nicest of circumstances.
Well, I haven't heard that. That's a surprise to me. They're just down the street, but I don't really have lunch with any of them. But, that would be a surprise to me. I'll let you take the lead there and stay out of it.
All right. Well, we'll let you know when we get it for sure. Bill Gross of Janus. Great to see you. And now